This is Tom Aspray with the Viper pre-election market video for the week ending November 1st. The market action over the past several weeks has been determined by the bond market as yields have moved higher for a good part of October. This first chart is the 2-year note yield. It was down under 3.5 in September as stocks started to rally, and now it's at 4.212%. You can see the daily MACDs did a pretty good job of catching that low. However, because of the weekly were negative, I did not expect it to go as far as it has. That's been the problem for most bond traders too. Daily lines are still positive. MACD histogram, as is the other case with the other instruments, does show a divergence, but that could take another week or so before it generates a sell signal, or of course not at all. If you look at the longer term, the 30-year bond, this is a weekly chart. It just closed above its downtrend here, which of course has more serious ramifications. You can see that both weekly MACDs are positive and rising, and that suggests if we do get a daily sell signal in the next couple of weeks, it may just mean a pullback, not the end of the rally. Lastly, we take a look at the 10-year T-note yield. Made it above the 61.8% resistance at 0.4309 today and closed at 0.4361, up pretty sharply. So, the daily Stark bands are at 0.442, additional resistance at 4.485, and then 4.637. Lower highs in the MACD histogram. If you look back into, what happened in April, you can see that, we needed to have a pretty good break to the downside to generate that sell signal. Probably 4.20 is the level to watch. Of course, we get the FOMC this coming week, and they are expected by a good majority, not as strong as it was a couple weeks ago, to lower rates a bit more. Let's look at the markets. New York Composite monthly basis did close lower, down 1.4%. Everything else looks pretty strong. Major support down here in the 18,000 area, with minor now at the yearly R2, which is at 18,548. That's about 700 points below where we are. Week monthly indicators have turned down, but show no signs of a top, and still strongly positive. So, not a problem here. Last week we looked at the weekly analysis, with the sharply lower close last week. We're looking for some more selling this week. We got it, okay, because it's down little over 1% for the week. The AD lines are still looking pretty strong, still above their moving averages. It'd probably take another week of selling at least to get us back to the rising moving averages, but still no signs of that it's going to flip into the negative territory. Similar picture with the S&P, the Spider Trust. A little sharply lower close here, is down 1.4%, so it was weaker than the NYSE. Also still above the weekly S&P 500 AD line. Stocks only, is getting a little closer, and the all AD line, all the weeklies are positive. The dailies did close the week negative, so there's a daily chart here. You can show we're already getting pretty close to this, support going back to the start of October, and also the July highs, and the 50-day moving average is at 568, and the low, was tested that on Thursday. As I mentioned in a tweet Friday morning, I didn't like the internals as the day progressed, and so you can see that we did close near the lows in the Spider Trust. S&P 500 daily AD line, has dropped below its moving average. It's still above the October lows, so it's acting a little bit better, with major support coming here at line C. Clearly, sentiment has gotten a bit more negative. This is the put-call ratio, the total put-call, so 1.12, so roughly that means 12% more puts were purchased than calls. The VIX analysis, we hit that resistance. We've been watching this line D, but turned down on Friday. If you look at the index put-call ratio, it's even more indicative of put buying, in the market tracking ETFs, 1.70. That's the highest of the year. If you look at a longer term chart, you have to go back to April, May of 2022 to see this heavy a put buying. You can see at that point, we got a bottom and a rally, and then another sharp push to the downside into June before a bottom was formed. So far, the evidence does not indicate such a sharp decline as we saw then, but we're watching the data, and certainly the outlook weakened with this week's declines. You can see the NASDAQ 100, the QQQ, down 1.6% for the week, still holding very close to its highs. AD line has been leading prices higher and made a new high 2 weeks ago. It's pulled down, so it's got lots of good support at its moving average in here. It forecast a new high in the Qs several months ago, and that is still the favored scenario. The relative performance stayed above its moving average last week. It flipped above it a week ago, so that's still positive. If it were to break below that support at line E, that would suggest that QQQ was no longer leading the SPY, so that flipped more into the value rather than the growth space. The daily shows the sharply lower open on Thursday below the 20-period EMA, and you can see it's already getting kind of close to its Stark band equivalent at 477. And interestingly, the QQQ AD numbers were positive on Friday, so you can see we hooked up back above its moving average. Typically, if you saw this sort of action, say 5-10 years ago, with that week of close, you'd almost be a high probability that we'll see more selling Monday morning, and certainly we could, but in the last few years, that relationship has become a bit less reliable. So NASDAQ AD line, good support from the September highs, and then the lows, and the lows into early October, this line A, and then a major down here. So while the short term could favors the downside, the longer term does not. Looking at the RS analysis, it looks a little more positive too. We broke out finally above this resistance at line E. Didn't take out the August high, but as with the Friday's action, it turned up from its moving average. Number of new highs dropped pretty sharply last week. It got down to 64 and 64 new lows. So, this early September peak, just over 100, and then the 225, I think, peak in August are the next levels to watch. So we're diverging here, but, typically, back in 23, we got a pretty good sell signal here in August, as yields were moving higher, and the pickup in new lows confirmed the divergence in the new highs, which was a bearish development. Looking at the growth value relationship, you can see it turned down last week after a nice pop to the upside, still above its moving average and therefore positive. You can see the MACD lines are getting closer to crossing, as is the histogram, is at 0.001. Let's look at first at the ETF report review as of last week's close. Deteriorated 57.7 down from 66. And last week there were a number of negative weekly sell signals. Let's take a look. This shows you the deterioration 57.7, and the growth went down to 80, but only 30% have daily positive detail. Here's the whole list, quite a range. A bunch of real estate, high yield, the box, HYG, generated a negative signal. And added a bunch of the small cap energy, the small caps in general, and the oil and gas. Apple's also on that list. ITA, that's defense. I guess that's if you look at that as a barometer for more war in the Middle East, that might be a good sign. And XLRE as well as VNQ. Of course, as I've been warning for the past few weeks, the pre-election time is typically pretty choppy. It's maybe analogous to the market's initial reaction after a Fed announcement and press conference, and the traders that are on the floor then either really like it or really hate it, and then next morning, totally different opinion. So you can see mainly gross sell signals, home building, and healthcare. Value, XOP, VDE, weekly sell signals. XLC continues to be a strong one. The short ETFs, positive DTS, and negative weekly. And as one might expect, the leveraged longs are negative DTS, and then a mixed bag. So in the energy sector, 25%. Hess and Chevron are the only bright spots. Before we get back to that, I should update you on the trend table. You can see energy went from 41 to 25. XLB had a real sharp. It looked like it had a pretty good uptrend going, 33%. Same thing for XLI. Those were two of the stronger looking ones heading into the last couple of weeks. So, as I said in my commentary, that'll make this next week's action more important because, only two closed above 50%. That's XLF Financials and Communications. So XLB, XLI, XLY, Consumer Discretionary, and XLK, showed a drop below the 50 level. So, this is sort of new science. I've been looking at the trends here, and it seems that does appear to be at a significant level. So, these could always flip back. It wouldn't take a lot next week. But you can see lots of, only XLF stayed, at 72.7, XLC at 91. So, that's not, a great positive sign. Let's look at the other table. You can see that, we had weekly DTS, healthcare still negative. We flipped on consumer staples and in the real estate, the XLRE. Also 3-day, in the XLE energy, not too surprising. Utilities a little bit more surprising. And the XLE had already been negative 3-day. So a fair number of 3 days. So it'll be interesting to see no positive DTS at this stage. So early in the next weeks, that's what I'll be watching. Back to the sector table. It's energy materials. We can see a mixed bag. A fair number of greens, but no new greens. So we'll look to see how that rebounds. Based on this, you'd think that Freeport-McMoRan and NUE might be the first ones to watch for a bounce. Industrials also definitely a mixed bag. Longer term still looks okay. Shorter term looks pretty negative. Consumer discretionary, Amazon's a really bright spot, and Tesla are holding things up. And TJX, has a 3-day positive, but no other negatives, and 1 hour flipped on Friday. So consumer staples, CL rather, was one of the few that flipped positive based on the scans. Healthcare, Abbott is one I like. New DTS, new 3-day DTS, and a pretty good chart. So it's kind of washed out. Sentiment on healthcare, is about as negative as I've seen it for a while. Not sure what the cause, but lots of political infighting about the future of healthcare, so that could do it. Financials looking pretty good. Really, just the SPGI and MMC, are negative across the board. Information technology, Apple had a rough week, so it generated a new weekly sell signal, as did ACN and AMD. AMD was really hit hard. So, it got that transition from a week ago where we started to have daily to 3-day, now to weekly. Communication services still, Charter Financial, CHTR, Charter Communications, I guess it is, new positive. EA and Google, all showing good signs. Utilities, the opposite. There's a few that are green still, but it'll take a pretty good turnaround there to suggest that this sector is ready to rally further. On the Viper report, we have a few new articles we're putting up. We had an article about, talking about strategists raising their upside targets a couple of weeks ago. And, of course, the market, did sell off. Doesn't suggest yet that's a major turn, but, the data will tell us more. So we'll be looking next week. The longer-term patterns of the AD line, I hope to put out an article this weekend discussing that, does favor higher stock prices into the end of the year, no matter who wins. A trading lesson on how to buy the dip. Those are the set of techniques we use in the Viper ETF report and the Hot Stocks report. We tightened up stops on our stock positions, so we got stopped out of a few things. Also, energy, we used to stop under the quarterly pivot, so we took a 3% loss, both to investors and traders. This is not updated as of the end of the week, but still have some very nice open profits, some going back quite a while. For example, an SPY as an XLC. So back to the Viper report if you'd like to sign up. Otherwise, look for more commentary between now and post-election. Thank you very much.